My name is Stephen Stewart, and I am the CEO of Power Ore Inc. We're a brand new company. We're very excited. Just launched in early June on the Toronto Venture Exchange under the symbol PORE. We've got $1 million in cash as of our list. We've got less than 30 million shares outstanding, incredibly tightly held. We've got a very strong group of shareholders, and we own 2 advanced stage assets in the Galganda Cobalt camp of Northern Ontario, just a 5-hour drive on paved highways from Toronto. And we are going to be aggressively acquiring additional assets in the nickel and cobalt space, all in order to gain upstream exposure to the explosive growth that we see in the electric vehicle battery market, specifically cobalt and nickel, which are 2 of the key ingredients that go into these batteries. As you see here, we think there's an energy revolution. We think it's already here. We know it's going to grow substantially, and cobalt has been a major part of this. So that's why we say cobalt for today. Cobalt will continue to be a major part of this, and nickel for tomorrow means that while nickel is a major, it's in fact, we think it's the real battery metal. It's been overshadowed by cobalt and lithium, but we think that's going to change. In the meantime, there's great opportunity to acquire fantastic advanced stage nickel former producing mines and established resources in Canada, in the Abitibi, and there's going to be a big run in nickel, and I'll get more into detail about that as we go forward, but that's effectively the elevator pitch for Power Ore. Very tightly held, well capitalized, acquisition strategy for growth, and direct exposure to the electric vehicle battery market. So this is a forward-looking statement. You see this, it's ubiquitous for all exploration and development mining companies here. It basically tells you that exploration and mining are very risky businesses. We invest for multiple times our money, not for 2% returns, and hence that means it's a risky business. So beware. So our vision, the essence of Power Ore is really all about taking advantage, capitalizing of the energy revolution. It's already here. Not everybody realizes it, but it's, if you look closely, you'll see signs. There are electric vehicles all over the place. That whole movement started not necessarily about global warming, but largely because of pollution. So it started off as an environmental movement, and that was fine, well-intentioned. But things don't take off until the economics make sense, and the economics are starting to make sense, and they're going to make more sense as technology increases, and it's doing so at a rapid pace. We're near cost parity, which is the tipping point. So it's not just about the environment anymore, it's about performance. And when I say performance, you look at a Tesla, it outperforms any $500,000 Ferrari, Lamborghini, Porsche, you name it. The performance is superior for electric vehicles over ICEs, and ICEs are internal combustion engines, and you'll hear that acronym throughout. But the performance is superior. That's great, but you know what it's all about? It's always about the economics. You got to follow the money. And until the economics make sense, your average Joe is not going to buy a Nissan Leaf or a Tesla over a Camry. It's just not going to happen. It has to affect their pocketbook. And that is now on the horizon. It's a lot closer than people think. Already, most people don't know this, already today, renewables, meaning solar and wind, are the cheapest sources of power to produce. And their prices continue to fall, and they've been falling rapidly as technology increases. Everybody remembers solar panel, or I should say plasma TVs were $10,000 and $20,000. Now you can buy them for less than $1,000 at Best Buy. The same technology, economies of scale are happening with solar and wind, and it's cheaper to produce than it is to burn any fossil fuel, coal, nat gas, you name it. Renewables are cheaper. Now the problem has always been, and still in a sense remains, is that the sun doesn't always shine and the wind doesn't always blow. And when you want to use that energy, you need to do it on demand. And so in order to capitalize and use these renewables efficiently, you need to store it. And they store it in batteries, and in batteries all have different recipes. There's batteries for cars, there's batteries for phones, which are very similar in terms of chemistry, and then there's grid storage batteries, which are completely different recipes and something that Power Ore is not focused on for the time being. We are exclusively focused on the EV battery market, which is the lithium, cobalt, and nickel space. So it's all about cost parity. So when the batteries become the EV batteries and the EV cars themselves become the same price as an average ICE Toyota Camry, well, guess what's going to happen? We're not there yet. As I'll just scoot forward here, a couple slides here. So this is where it was. You see, as little as 5 years ago, these EV cars were over double the price. No, they didn't take off. Nobody was buying them because maybe they were green, but they weren't economic. We can see that cost decline in the green line there from your average EV to your Toyota Camry. In 2021, it's projected that we're going to get cost parity. So what are you going to buy? A greener, more efficient, better performing car that, or the old school stuff? I think the smart money thinks you're going to buy the EV, and there's going to continue to be incentives, not just feel-good incentives, but economic incentives coming from the government. All the way to China, all the way down to Ontario, provide serious incentives for these, and that will continue. So scooting back here, this is the story of the battery demand. It started off in the 90s with your camcorders and your laptops, and then of course your cell phones and your iPhones, and that's where the real lithium ion, which really should be called a nickel cobalt battery, has been taking off. And you can see it's really expecting explosive growth when you get the cars in there, and the cars have been going on for a couple of years now. In 2018, they're really starting to take off, and that is going to continue to grow exponentially. At the end of the day, the growth all comes down to economics. Again, this is not an environmental movement. This is an economic and performance movement. Cost of batteries have been and continue to be the impediment. We have 1% sales in EVs, but that's going to change dramatically as this bar chart continues to reduce. 2014, the average price for a lithium-ion cell was $280. Now it's about $120. Significantly declines in a very short period of time. It's related to Moore's law in technology and how it gets twice as good at half the price every 18 months. And so that, I'm not sure if that follows it exactly, but the trend is the same. We expect that to continue, and hence, the price parity, as I said before, price parity by 2021. That is not too far away. That's 2.5 years away, where the cost of the car will be the same as an internal combustion. And then I think, the operation costs obviously pay for themselves as well. It's a lot cheaper to operate, not just to energize them, to plug them in is a lot cheaper than putting in a tank of gas, but also the moving parts. There are significantly less moving parts on an electric vehicle. In fact, there are very, very few moving parts. And as we all know, the fewer moving parts, the better. So the maintenance and the costs going forward of these cars all add to the argument of superior performance, not just acceleration, but maintenance and cost. All the big guys, Ford through Ferrari, and everyone in between, Porsche, Audi, VW, Honda, BMW, they've all taken note. Obviously, they have to. If they want to stay in business, well, you better get an EV. They have all made significant shifts in their strategy towards capitalizing on this. Everybody's either offering an EV, or actually some of them, I believe Volvo is committed to going exclusively EV. So this is not a niche trend. This is the real deal. Everybody's taking note, and the entire industry is forced to transform. So this shows EV growth forecasted from the past all the way to the future. You see all sorts of different projections. I'm always very weary of projections that go out anything further than well, really tomorrow. But certainly, if you go out years in advance, all bets are off. But you know what? This just gives you a sense of what it's going to be. Today, right now, 1% of new car sales are EVs. That's nothing. Barely scratched the surface, but look at the demand that it has had on cobalt and will have on nickel. 1% is almost nothing, but that's changing and changing fast. The experts are saying, as this slide indicates, 35% by 2040. I've heard 30% by 2020. Doesn't matter. The point is significant growth. Who's driving this? Everybody knows Elon Musk and Tesla, but that is a drop in the bucket. It's China who is driving this bus. They are by far the largest car market and by far the largest electric vehicle consumer and producer at the same time. Their production cars are exponentially greater in units than those of Tesla. So, and that all stems from government policy. The Chinese government has absolutely mandated that electric vehicles become a major segment of their market. People in the big cities in China are just absolutely suffocating from the pollution and the smog, and the people are outraged, and the government is reacting because they have to keep the people happy, otherwise they have a revolt. And so they have had significant incentives, not only financial incentives, but they won't even let you buy an internal combustion car. If you're in the big cities, they control the purchases by issuing license plates. If you do not have an EV, you simply cannot get a license plate. It's as simple as that. They're forcing you to buy an EV. The demand growth coming from China is absolutely astronomical. And Europe is not far behind. Obviously, Europe isn't as big as China, but they're very much advanced in terms of their purchasing EV, particularly because of the high cost of gas. United States and Canada are quite a bit behind Europe and China, but we're catching up quickly, and we will as soon as cost parity comes online. And so there's going to be huge growth driven by China, and everybody else is going to be forced to follow. Aside from the cars, this electrification and the battery energy storage has more incarnations and more uses than simply the car. Just think about the buses. I love this stat right here. 271 new EV buses are brought online in China every single day. I mean, that is absolutely astonishing when you think about it. That is the equivalent of the City of London, and everybody knows the London iconic buses. China is replacing with electric buses every 5 weeks the same number of the entire fleet of the City of London bus system. That is what's happening in China. That is what's going to happen across the world. It's astonishing growth, and it's all being led by China, but the world is going to follow because, again, it's not just about performance, it's about economics. And then, of course, the side we don't talk much about, I don't have a slide for it, but trucks. Everybody's seen the Tesla truck. Same economic supply. Trucks drive as many kilometers on a gross basis as cars, so trucks is also a huge growth market. So it's really all about the growth of the battery markets itself and how PowerOr and our competitors are going to be supplying the ingredients, the key inputs that actually go into manufacturing these batteries, which are obviously in huge demand right now. So what are these batteries? As I said before, they're different battery types have different recipes. If you're looking for grid storage batteries coming in your garage or industrial uses, well, they have different components. They could be made of carbon, iron, all sorts of commodities. But when it comes to transportation stuff, if you want to have a skinny phone, you need weight to energy density. If you want to be able to have a fast moving car, obviously weight is important. And when you're considering weight to energy, it needs to be this recipe or something close to it that includes nickel, perhaps cobalt. No, nickel and cobalt for sure, sometimes aluminum, sometimes manganese. You see these different NCA, NMC, that stands for either nickel, cobalt, aluminum, nickel, manganese, cobalt, etc. The numbers there, the 111 or the 811, represents the respective ratios of the commodities. The NMC 111 means 1/3, 1/3, 1/3. The industry seems to be moving towards the NMC 811, which in effect lowers the cobalt input from 33% down to 10% and increases the nickel component. And that's why we say cobalt for today and nickel for tomorrow. Now, when you think about cobalt, everybody says, oh, well, they're going to engineer cobalt. Well, that's just simply not true. At least with the current incarnation of technology, we see that as being impossible. And the reason being, cobalt stabilizes the chemistry of nickel. If you take out the cobalt entirely and you just have nickel, you have what's called high risk of thermal runaway. And thermal runaway, you Google it on YouTube, you'll see it's not a good thing. That's when the batteries catch on fire and they don't turn off. So very dangerous. You need the cobalt to stabilize that chemistry. So while it's certainly possible for cobalt to be reduced from 30%, say, down to 10%, it will be replaced by nickel. And that's why we think nickel is really the underdog and the undervalued opportunity that we're going to be taking advantage of. So it's also important to note that while the engineers are trying to reduce the cobalt, they will not get it out. But the growth factor, just because it's being reduced from 30% to 10%, doesn't mean that the market is shrinking. In fact, the market is going to grow substantially, because now that cobalt is a lesser component, you can produce these batteries at a cheaper cost. Cheaper cost means they're going to sell more units of batteries, hence you're going to increase the overall gross demand for cobalt. So the cobalt story, even if they do whittle it down to 10%, fine. That's actually great for the cobalt market. There will be greater demand for it. Also, simultaneously, great for nickel. Nickel is a huge component today. Right now, it's 65 to 85% by weight of the cathode of any nickel. There's a quote that I have here down later in the presentation that talks about, Elon Musk said they shouldn't be called lithium ion, they should be called graphite nickel batteries, because that's effectively what they are. The lithium in them is only, as he says, the salt in the salad, and that's the truth. So nickel really is, in our opinion, the real battery metal. Right now, it's overlooked because it's a much bigger and deeper market, but I'm going to talk about that in a second. And it's only going to grow. So nickel is quite exciting. These are the key inputs here for the battery metals and their different recipes and components, but cobalt and nickel will remain a critical component of all these things. A lot of my contemporaries and competitors talk about the cobalt supply. I will brush over this because it's well known, but very briefly, 65% of it, or up to 65%, comes from the DRC. Take my word for it. You do not want to do business in the DRC. I don't care what they say. It's not a nice place to do business for a whole lot of reasons, not just because of the child's labor and slavery. That should be the first and only reason you don't want to do business there, but there's a whole host of other reasons, from war, Ebola, an unfriendly government, just all in all a bad place to do business. And people like Apple and Tesla, they don't want to be seen to be doing business there. Right now they have to, but that will change as there is, some more supply chain accountability on commodities these days. Where are they going to go get it from? Well, there's only so many places you can get, and cobalt is, as you may not know, it's 99% of it comes from a byproduct from either cobalt or nickel. Copper or nickel. The copper comes from the DRC and their Cobalt there. The nickel comes from either Voisey's Bay, the Sudbury Basin, or Norilsk. So that's another complicating factor of cobalt. There really is only one primary cobalt mine in the entire world, so the rest of it comes from another mine where another metal is the primary product. Hence, that complicates the economics of increasing the demand. If cobalt goes through the roof, well, maybe that mine is still unprofitable with nickel prices right now, so you can't increase the supply because it's really a nickel mine or a copper mine, etc. So it just sort of adds to the complication of the supply-demand fundamentals of cobalt. It has other uses, but really the growth story is all about the EV. So that's cobalt. It's a byproduct. It comes from a bad place in the world. And if you can get it in a secure location such as Canada or Australia, all the better. Canada, of course, we think is the best place in the world to do business for a whole host of reasons. And we'll talk more about our cobalt asset in former producing mine with excellent grades in just a few minutes here. This is just a little bit more on the supply deficit forecasted about cobalt. I don't like to get too much into the forecasts. Things can change, and it's really just monkeys throwing darts at boards when people guess about the future, and nobody has their crystal ball. But you can certainly see that there is a lot of expected demand and complicated supply chain issues when it comes to cobalt. So nickel, let's talk about nickel again. I repeat, nickel is the real battery metal. If you look at the batteries right now, it's at least 65 to 85% by weight of the cathode, which is a major component. That's only getting more as the technology improves. Nickel by weight is significantly cheaper than cobalt. It has excellent weight to energy density ratios, and hence all the battery manufacturers are wanting to substitute cobalt for nickel. Again, cobalt's not going out of it, but it is going to be reduced. This is the Elon Musk quote. You said he really forecasted nickel, and this quote goes back a long time. When you look at the history of nickel on a per pound basis, it has been down in the dumps since 2005. It hit a low of $4 a pound. It's flirting with $7, so it's come back, but it hasn't taken off. And if you look at the prices going back, the 2000, before the financial crisis about 10 years ago, it was upwards of $24, $25 a pound. So when things are good and nickel's in demand, it has a long way to go between $6 and $24. That's the sort of upside potential we see. And given the new demand with the battery technology, the battery supply and demand for nickel, who knows? Maybe nickel runs a lot further than it did in 2007. Entirely possible, because we have a new major use for it. And I think what's important about the nickel, and this is just some more supply-demand imbalances, what's important about the nickel is that it's actually bifurcated. So most people don't appreciate this. There are two classes of nickel: class 1, class 2. Class 1 is sulfides. Those are deposits you find in Canada. Class 2 is the laterites. Those are deposits you in Australia, or mild or hot climates have been weathered. Why it's called class 2? Because simply it does not produce as good of a product. The product is not suitable for battery metals. You can upgrade or beneficiate it, but it costs you a lot of money to do it. When you have the class 1 or the sulfide deposits found in Canada, you do not have to upgrade it or beneficiate it to the same degree. And hence, those two, class 1 and class 2s, actually split the market 50-50, almost right down the middle. So the bottom line is only 50% of the nickel market is actually applicable towards the battery metal world. So if you have a sulfide nickel deposit, you are sitting pretty. And those are exactly the type of assets that we will be chasing. Those are the type of assets that we own out in our McMurtry property that I'll tell you about. But it's important to note that nickel is bifurcated, and also nickel has a very, very bright future, because it's been down in the dumps and there hasn't been a lot of exploration, and the inventory where they store in warehouses has been drawn down because of the lack of supply. Right now in the basin, they produce nickel at over $6 a pound. When it's at $6 a pound, they're breaking even. So they're drawing down the warehouses, and they've been doing so for quite some time. We expect a resurgence in nickel, even without the battery metal story. But when you layer that on top, we're very, very pro nickel. So let's talk a little bit more about Power Ore. The previous slide was really about giving everyone the narrative of what's going on with respect to demand for electrification and how that all gets stored, and how electric vehicles are really the future of how you and I get from point A to point B. So again, cobalt for today and nickel for tomorrow. We mean by that is that cobalt is clearly in vogue, and we continue to see that very strong, but it's the real story in my mind is about nickel, and how we can rotate some good valuations we're going to get for our cobalt asset and use that to leverage into some very undervalued, high upside nickel opportunity. It's unlikely, I'll be honest, it's unlikely that cobalt's going to go up 300-400% like it has in the last 2 years. But you know what? It's probably likely nickel will. So that's where we're positioning ourselves also. And keep in mind, oftentimes nickel is associated with cobalt. So if you find a nickel deposit, sometimes there's cobalt in there. So what are we going to do? As I said off the top, we own two great assets: a former producing mine, another advanced stage nickel project called the McMurtry. All have drill holes, all are easy to drive to, and you're going to see us acquire more properties like that. And we are focused on a large scale. We want to hunt elephants. We want big deposits, not small ones. We want Canadian deposits because it's the best place in the world to do business, and we're only going to be focusing on these supply inputs that are directly exposed to this fast growing, almost tech-like growth industry. So we're quite excited. Again, this slide just talks about the paradigm shift that's happening. Again, I can't emphasize, I encourage you to do your own due diligence on this, but if you do, I think you'll come to the same conclusion. The way we see it is really akin. Canada's north, Ontario, the Abitibi in Ontario and Quebec is really akin to the oil fields of Saudi Arabia, 70, 80 years ago. It was, although there's tons of value there right now, there's tons of untapped wealth. This in situ metal, this nickel, this cobalt that's in the ground is going to be in such major demand, just like the oil fields of Saudi Arabia have been for the last many, many decades. But those oil fields are going to become less and less important. We do not think oil is going away. Far from it. Fossil fuels will be around for a long time, but there is definitely room for renewables and battery technology to take a bite of the pie, if you will, and continue to grow for a long time to come, and eventually supplant the oil entirely. But that'll take time. But in the meantime, there's huge growth. The energy business is, while I can't say empirically, I would wager, I guess, it is the largest industry in the world. So Power War, what do we look like? We are a brand new company listed in June 2018 on the Toronto Venture Exchange. We're a brand new company, tightly held. We have cash. We have $1 million as of close. That doesn't mean we're rich, but that means we're very comfortable. We're not spending money on exploration. We are not interested in grassroots exploration. We're not exploring out of the gate. We are an acquisition vehicle. We want to buy more of what we have. We've got 2 great assets. We want a third, a fourth, and a fifth, etc. If we are right, and the nickel and cobalt fields of Canada are akin to the Saudi Arabia oil fields, well, we want to buy as much as we can. We will worry about drilling them out in a little bit, but first things first, let's own really good assets. Again, no grassroots exploration. We are taking advantage of what other people have done in the past. Right now, because of the industry economics, we can buy stuff for cheaper than it costs us to drill it and discover it in the first place, and do so with a whole lot less risk because we know what's already there. We will buy stuff that has already been drilled and understood, but we also, upside is key to us as well. We spend a lot of time on the due diligence and understanding the geology. We've got a very strong technical team, and we know exactly what we're looking for. In terms of debt, we don't have any. In terms of option payments, we're not going to make any. We own our assets, and that's something you'll see us going forward. And again, less than 30 million shares outstanding, very tightly held. 36% of that's owned by Orefinders and its shareholders. The management and the board, the insiders of Power Or are very significant shareholders as well. We have skin in the game, as we have always done in our company. Oh, a little bit more about the 2 assets that we do own. The first, and our flagship, by far the most advanced, is the Man Mine property. A lot of former production, a lot of recent 43-101 drilling with the core, very important. It has, as I said, former cobalt silver production. It has 9 shafts, so a lot of history. They were producing on this thing over a period of 70 years, most recently as of the late 80s. There is a ramp that you can drive your car right down to into the mineralization. There is a paved highway that runs right through the project, and of course, there's recent drilling, and you can see some of these intersections. As I said, or maybe I didn't, all of these projects in cobalt are in fact silver mines. Don't let anybody tell you any different. They're silver mines. Look at those silver. You need the silver to pay for the cobalt. 30 meters of mineralization and over 5 ounces, or I should say 5 ounces over 30 meters of mineralization. Fantastically rich grades over very wide intersections. They do occur in high grade shoots throughout those intersections, but they're parallel zones and offer really good mining opportunities there. And then within this bonanza grade cobalt, you get blooms. So little pods, if you will, of high grade cobalt. And on the Man Mine, we drilled a 1.4 meters over that has over 1%. Now, a little bit of context about grade of cobalt. The 99% of cobalt that comes from the nickel and the cobalt, you'll see that comes in a 0.01 or 0.05% cobalt. So these types of deposits in Cobalt, Ontario, have a unique style of mineralization that offers extremely much higher grades of cobalt, and that's why there's so much interest in the cobalt camp right now, because of these unique grades. But don't forget about silver and some of the other mines there as well. So again, it's 5 hours north of Toronto, paved highway, former producing mine, huge upside, excellent place to do business in Ontario. This is just a little further zooming in here. The cobalt area of Ontario is where Canada's mining industry began over 100 years ago. Full stop. The saying goes, Toronto was only known as a place to change trains on your way to Cobalt when you're coming from New York and all these big financiers came up. Cobalt has a lot of history. That's where the mining industry began, and that's where it's having a revival. So it's actually very interesting. And Power Ore is extremely fortunate to own a property right smack in the middle of this district. Again, further grades here, there's been a lot of recent drilling. I encourage you to, on your own time, go back, check out our website. This presentation's on there, and you will see numerous very high grade, bonanza grade silver, also very high grade cobalt. And then our other property, the McMurtry nickel property, not to be outshined, but it's not as far as along the road as the former producing, but it does have a lot of smoke. You can see here it's got over a 7% nickel intersection over a meter. That's not a very wide width, but that is an incredibly high grade that also has precious metals, platinum, palladium in there as well. Right now they're mining, and you can get them mine at 0.5% nickel, or if you have high grade, it's a percent nickel. So to get 7% is actually very encouraging. Obviously, more work is required on all of our properties, and any of these properties in the area require more drilling. But that's awfully encouraging to get a very, very high grade intersection like that. The McMurtry has an awful lot of potential, and clearly a lot of nickel in that system. So two fantastic advanced stage, already drilled projects within Power Ore, and more to come. Stay tuned. Now look at our comparables. Who are our comps? You can see them there. We list them there. We put our shares outstanding. We are at least half, in some cases, 1/8 of what they have outstanding. We're very tightly held, very new company, not a lot of dilution. We've got good cash, and we've got good assets. Our assets stand up to all of our peers. Every single one of them. It's our asset, the Mann Mine, is as good or better in terms of grade, production, stories, etc. It holds up to anybody in the area. I think when you are doing your due diligence for our valuation out of the gate, you're looking at our comparables, you're looking at our cash, note a few things. Do they have historical production? If they do not, I recommend you discounting that opportunity. Historical production is very, very important, as is historical drilling. A lot of these people have not even drilled their properties. Be wary of those who report grab samples. Grab samples are nothing more than a geologist walking in the bush and grabbing a pretty rock. They do not grab the rock that doesn't look pretty. So be wary of that. A pretty looking rock on the ground does not make a mine. The only thing that does is drill holes, and you have to have the core in order to support that. So drill holes from the 1950s with no core, in my opinion, don't count. You need the core to verify the accuracy and the validity of this. And we've posted it here on this website as well. We have all this core. We will be re-assaying a lot of for cobalt, because it was the time when this was done. Cobalt wasn't a thing. Silver was. For some more cobalt, so we suspect we'll have some additional cobalt intersections to come. So please, do your due diligence, look at us versus our peer, and then understand we're not going to rest on our laurels. Our management team has proven that we are very active in what we do, and you will see us acquire additional assets that look and smell like the ones we have. It's about gaining a critical mass at this point in time. Again, if this is the oil fields of Saudi Arabia, we want to own as much as we possibly can, as opposed to just drilling what we do have right now. The time will come for us to drill. It's just not today. It's going to come, but it's not today. In the meantime, let's buy some really good assets. Now, who are our team? As I said, my name is Stephen Stewart. My background is in finance. I'm very experienced in valuation, and have a very good understanding of not only the geology and the engineering behind mining, but also I have good relationships and knowledge of the assets in Canada. That's where we focused. When I say we, my partner, my father, and our executive chairman, Alex Stewart, I've worked with him my entire life. He is I guess, classically trained a corporate securities lawyer, but has been a mining entrepreneur for 20 years alongside me, alongside him. And Charles is the third pillar of our core management team. Obviously, Alex has his skills as a lawyer. My background's in finance, and Charles, of course, is our geologist. I will put Charles up against anybody in the Abitibi in terms of his understanding and his knowledge of the science and the rocks in the Abitibi. He is a true geoscientist. We're fortunate to have him, and he certainly is a very, very important part of our team. To round out the board, we have Tim Gallagher. Tim Gallagher, I've worked with him many times. He's the founder of Macalla Royalties, which has been a tremendous success over the past 18 months and so. And then Tony Moreau, head of innovation over at IM Gold. and is a CFA. And then Gotham is a new member of our team and a corporate development manager, former investment banker, masters of geology and MBA as well. So we have a very, very strong team, and we're committed to ultimately creating value for our shareholders. As I wrap this presentation up, I'll make it very clear. We are on a mission to make money for our shareholders. Many junior companies sort of lose sight of this and get on some mission to build a mine or mission to drill a hole. That's not our mission. We are significant shareholders. We understand that our shareholders care about two things. First is, what do they pay for a price of power ore? And the second, of course, is what can they sell it for? And every decision we make comes down to that, and how can we create value on a per share basis. So as a management team, we're very technically competent, but we have a strategy that I think is sound in terms of gaining exposure to a fast growing industry, while also keeping the bottom line in mind, and is that how can we make our shareholders money? So with that, I'll wrap it up. Again, my name is Stephen Stewart. I'm the CEO of Power Ore. Proud to be so. Brand new company. I'm always available to shareholders. You can call me at 416-644-1571 anytime, or my email address is there. Thank you very much for your time, and we'll look forward to hearing from you and participating in Power Ore, PORE, on the Toronto Venture Exchange. Thank you.